Hello, hello.
Can't hear you, Cindy.
I think what we should do,
Hello.
mute yourself. Do this. Okay. That's better.
Okay, you can hear me?
Uh-huh.
All right, cool. Can you hear me, Christine?
Wait, hold on. Say it again.
Can you hear me, Christine?
Hi, I can see you, Cindy, on your laptop,
Okay,
but I see the office, so we won't be able to see a screen that you share unless you're going to share it on the Keller Williams screen. You know what I mean?
Hang on.
okay, we're figuring it out.
Okay. And I see that Monty's not here, darn it.
Wait,
Yeah.
Christine, you can't see the real estate?
Oh, yeah, I see it.
Okay,
Oh, okay,
you're
good.
good, you're good.
I don't
Thank you.
got it.
Got it? Yep.
Okay. All right, can everyone hear me and everyone sees my screen that says all about real estate syndications? Yay, okay, let's do this. All right, so what the heck is a real estate syndication anyway? So what it is basically, we're talking about commercial real estate. We're talking about bigger complexes, office space, multifamily, that sort of thing. And what this world does is it offers, what syndication does is it offers opportunities for investors to get involved in these kinds of transactions. So I need these little.
Click on it and drag it over. But you're gonna have to go back to the Zoom.
Okay, I'll try sticking it over there now. Okay, a real estate syndication is a team of people that specialize in these larger commercial properties, and it's financed substantially through private investors. Oh, look at this. My window's over here. Yours is over there. But that's all right. I'll read these to you. It's financed almost all through private investors, although banks can sometimes be involved. And certainly the principals involved in the project will also do some of the financing. And then the investors, as far as you and me, if we were potentially investing in a real estate syndication, we would be presented with a pitch deck ahead of time. And that basically talks about what the project is that they're getting involved in and why they like the deal and what the deal actually is. And we then are able to decide, hey, does this sound like something I want to invest in or not? And once that we decide that we are going to invest, we're part of the capital raising process. So the syndication will continue to raise capital. And after they do their due diligence, then the deal will actually get started. Okay, so there it is. Yeah, as investors in this syndication, we actually have direct ownership, but comparatively small amount. So if I was to put in $100,000 in a $22 million deal, I have a very small ownership in it, but I do have a proportionate amount that I own, maybe 1% or whatever it is. But we don't, we get to benefit from any of the gains, but we also would be hit with any proportionate share of losses. So who can invest in a real estate syndication? So a syndication is considered an investment instrument, and therefore it's governed by the SEC. And the SEC has certain rules. Only an accredited investor can invest in most of these things. And that means that you have, as an individual, income of $200,000 or $300,000 if you're a couple, and you have net worth of at least $1 million. That does not include your primary residence. They also have allow sophisticated investors to invest, and these are, and I just read this very vague definition, but it's sufficient business or financial knowledge and experience to evaluate the risks of the investment. If you are an unaccredited investor, there has to be an pre-existing relationship, or you have to be referred by someone. And guess what? You all know me, so you might have a referral source here in case you had any interest. When you're investing in a syndication, what are you buying into? So you can look at it like, am I betting on the horse or the jockey? And if you're betting on the jockey, that means that you really want to know who the general partner is, who's also called the sponsor, and what they're all about. So you want to look at their character, their reputation, make sure it's somebody that you trust. What's their experience? Have they done this before? How many times? What kind of business model and process do they follow? You really want to get to understand the person and or the group that is offering the instrument. If you are betting on the horse, then you want to look at the actual investment philosophy. And that includes what kind of asset class is it? And by the way, it's interesting that we call homes assets, but when it comes to our primary residence, they're not assets, they're liabilities because they're just costing us money. We're not making money on the house that we live in. But when you are making money off of a property, it truly is an asset. So the different kinds of assets that syndications typically are involved in are office space, retail space, multifamily buildings, industrial or hospitality. And then there's different styles of investing. And these are kind of, I can liken this to the stock market. So if they have a fixed income style of investing, this means that it's a cash cow. It brings in money every month. You're not going to expect a lot of appreciation, probably because the property isn't selling. It's just holding there because it makes money. This might be some very established building like Walgreens, for example. And you probably aren't going to be able to buy into one of these kinds of investment styles because no one sells them. If you got a cash cow, you're going to hold it for life and pass it down to your legacy. But your hopefully other investments that you buy into will grow into this cash cow thing. There's also something called a core plus, and on these, this is similar to a growth and income type of investment fund. That means that there are things that they're going to do to these properties that are going to cause the value to go up. And that could be things like they might do some rehabbing, some lipstick remodeling. They might be doing some improvements in the common areas. They might be repainting the parking lot. They might there might be some tenants in there that are underpaying in rent that they're going to raise rents on. There could be any number of things to cause the investor or the syndicate to say, hey, this is making X dollars now per month, but we really expect to upgrade that in value over time and get more on a month-to-month basis and get appreciation at the end when we sell it. A value add is a type of investment style where they don't expect to get a lot of cash up front in the beginning because they're probably doing some more major remodeling and or they need to kick tenants out. There's going to be a period where they're not making any money. They're going to be evicting people. They're, the property's going to be down for a while. So initially there might not be a lot of value, but over time when they sell the project, they expect it to be worth considerably more. So this would be similar to like having a growth stock. And then there's opportunistic, which means this is the riskiest of all, but this would be like taking something and completely repurposing it, like old Costco location that they moved out of and nobody has taken over that location. So now they're turning it, they're converting it into a senior living facility or something like that. You're completely turning something into something that it was not, or you're building it from the ground up. That would be another kind of style. who are the players in the syndication? Well, there's the Mr. Big, who's the general partner, and he's also called the sponsor or the principal. And his job is typically to oversee the whole thing, but sometimes really he's just brought in for his name. He's the one who is able to get a loan from the bank, who's got the credibility, he's got fiduciary responsibility, so he'd be the last one to get paid, and he oversees the entire deal. And then underneath him, he's got the key players. So the deal specialist is the guy who finds the property, analyzes it, underwrites it, does all the legwork, and they are paid a fee out of the operations budget of the project. Now, a lot of these commercial guys here in our office are deal specialists. They go out there and they hunt and they bring in deals. The asset manager is another key component, and they make sure that they keep a close eye on the management of property, any upgrades, any tenant issues, collect rents, do reporting, and all that kind of stuff. And that's, they're also paid out of the operations budget. And then the last and very key part of this puzzle are the private money lenders or investors. They get paid when off of their split of the profits. So if I'm a 1% owner, I get 1% of the profits as an investor.
One question on the previous slide,
Yes.
Monty. So we as agents, can we also be a general sponsor, general partner and deal specialist both?
I could
If
barely.
we're putting the deal together, right? Let's say I'm putting the deal together to buy apartment complex of 100 units. I could.
Did anyone hear that? No? Could you repeat that again slower? We can't hear it now.
Okay, sorry about that. I'll try to see if I can make it better. Can you hear me okay?
Yeah, thanks.
So my question is that because we are, licensed agents, can we be the general partner and deal specialist both to put the deal together? Let's say I want to buy an apartment complex of 100 units. Can I put the deal together to bring in 5 partners and do that?
You absolutely can, and you are, that's exactly where I'm going with this next. So right
Okay.
now, I'm starting this presentation out from the perspective of I'm a potentially interested investor. And therefore, I want to understand how these work from an investor's point of view, and I want to understand what the general structure is. But then as soon as I finish this, I'm going to go into how you can take this knowledge now and turn this into your own sort of mini syndications yourselves. Ideas. And I think that's what you asked, right?
Yes. Basically just trying to see if we can be the persons driving it. That's what I intend to do.
Yes, I'm going to show you how you can drive it. Go. Okay. So in a syndication, there's a couple of different types of options. One would be either, it's called various things, either the operating agreement, the subscription agreement, the limited partner agreement. And this is the legal document that basically spells out who's got the rights to what. It's like having a business partner where you definitely want to have everything in writing as to what you should expect out of the partnership. And what are some of the contingencies if the partnership decides to end. The pitch deck or the private placement memo or the offering memo, that explains the deal in greater detail. And I'm going to give you an example. This is a syndication that I'm involved in, and this is the table of contents of the pitch deck. So it's got property information, it's got an executive summary, which is kind of the overall, what they expect to get out of this deal, what the business plan is, photos, financials, all of the data backing up how they came to feel that this is a good deal, their underwriting and everything. Some market and demographic information, comps, and all that good stuff. So here is the structure. You can see in this example that the limited partners are going to be comprised of 90% of the financing here. The general partners put in 10%. So what's good about this is that they have skin in the game. It's not all 100% your money. This deal is expected to return 8% per year, and it's going to have a shelf life of about 3 years. And the the minimum to contribution to get into on this deal, they were asking $100,000. And then the acquisition fees, asset management fees, various other fees are spelled out in this example. Some terminology that's really good to know when it comes to commercial loans is things like cap rate, which is basically the same as like your APR or your APY. This is how much you can expect to make on an annual basis. Your cash on cash is telling you based on what the project looks like today, this is what it's making today. And then the IRR, the internal rate of return, is what we expect it to make after all the improvements are made. Net operating income is how much money have I put in, less how much money is it costing me. The rest is profit, and that's your net operating income. CapEx is capital expenditures, which are the big ticket items. These are things that are not going to be on your income and expense sheet. They're going to be on your balance sheet because it's going to be things like air conditioning units, things that have a shelf life of more than 1 year. And the market value on these properties, there's no appraiser on commercial properties. There's no one who's going to give an opinion or look at comps or whatever. It's based on the operations. So, how profitable is this property? And that's going to determine what the value is. And then here's that example again that shows cash on cash. So it's currently, this project is making almost 5% currently, but after they've done everything that they expect to do with it, they expect it to earn more than 20%. That's pretty good returns. Investor pros and cons. Good things about investing. It's passive. It's totally passive. So as an investor in the syndication, you have to do nothing. You give them your money, you trust them to take care of it, you read your statements, and then do it again. There's portfolio diversification in the sense that if you are working with people who are like the regular people who go to work every day, 9 to 5, you have your 401k, your savings, things like that, that you probably put into the stock market. Most people have a stock market type of portfolio, but they don't have a real estate portfolio. They have primary residence maybe, but they don't have real estate. This is one great way for regular people to be able to invest in real estate without having to know anything about real estate or having to buy properties. Less investment, less risk. So clearly, if I was to buy $1 million house right now with 20% down, I'd need over $200,000 to do that. But you can get into a lot of these syndications with 50,000, sometimes 25,000. So it's much easier to get into, and therefore you're risking a lot less of your cash. There's a lot more upside than there is in residential. Way bigger ticket items, cash flow and economies of scale rather, more square footage, more rent, and longer leases, less vacancy risk. So clearly, if you have a building that's got 100 doors, you're getting rent from 100 people. That's a lot less risk and volatility than if you were to buy a single family home as an investment property, and you've got one door, one renter, and you've got all the eggs in that basket. So when you've got more, there's a lot less risk with much bigger properties here. And if it is an industrial or a business property, office building, for example, businesses tend to have much longer leases than personal. Valuation is based on the revenue generated, not on an appraisal, and tenants pay for common area maintenance. There's no such thing as HOAs. You don't have to meet any of these expenses. They all get wrapped into the project. And another beautiful thing is you can use syndication as your 1031 exchange. So if you do have a portfolio of investment properties yourself, and you're wanting to get out of that business, you want to divest those properties but not pay the taxes on it, you can put it into a 1031 or 1031 it into a syndication. On the con side, you don't have any control when you're in a syndication, but it's also a pro. Because you don't want to have control, let somebody else do it. On the con side, it's illiquid. Typically, these last for about 3 to 5 years. So you'd have to look at it like you were looking at a certificate of deposit or something like that, where you can't withdraw for 3 to 5 years. If you can do that, then there's nothing wrong with the fact that it's illiquid. High minimums, 25 to 50,000. I mean, that's all relative. I consider that a low minimum when you look at what you're buying into. And business sector is more volatile in a down market. So when business is going down, that's when people tend to shut their doors. So you've got to look at the business and use a little bit of common sense. So some advice here. Start small, roll your earnings, take advantage of compounding gains and delay paying taxes on the gains. Meaning that you go into a syndication, figure that that's where that money is going to stay. And when that syndication comes to fruition, take what you gained, put it into the next one, and just keep building until you're really involved in something big there. Understand market effects. Is the market going up, down, or stable? And how is commercial affected by that? What would you guys say the market is doing right now? Down, yeah. Unless, of course, you're talking about real estate, which is not quite down, but it's heading in that direction. So what commercial space would you want to be a little bit more wary of right now?
Retail.
Possibly retail. Possibly office, because things can be a little bit more. People don't necessarily have to go to the office to work nowadays. But then again, I'd look at the businesses, because is it a shady business? Is it one of those that kind of fly by night? Those I would definitely worry about. Is it a super stable business? Not too much to worry there. Do your due diligence before you invest in anything. These syndications, they take a process, they take experience, they take a team. Make sure that you're asking smart questions. I do have a list of questions that you should ask any syndicator. I forgot to, would you mind? Just grab a sheet of paper and let people put down. If you want my slides. And those of you on Zoom, just email me and ask for the slides and the list of the questions.
We can also post them in the drive, or on the YouTube channel. We could put them in the comments. Yeah, we'll put the link there. Yeah.
See what else.
So if, say you invest, it's going well for a year, and then something happens and it starts to tank and it's losing money. Can you pull your money out, or are you committed for that?
It depends on the project, and that's, you're gonna want to read the operating agreement to see what they say about that.
Okay.
And that's one of the questions that I put on my questions to ask was, what's the exit strategy if there is one? Are you stuck there or not? And that's gonna depend project on project.
Yeah, I had the same question for you, actually. What is the exit strategy from two perspectives? One is from the investor themselves, like what are the options they have? And the other is also you as a managing principal of the project, of the syndication. If somebody wants an exit, what are the options you have, right? So these are the questions I actually have on a more practical level.
So what I've seen is that sometimes there's options to have other partners buy you out. So that might be one way. You might possibly be able to do a loan against the syndication, so borrow your money out of there until it's over. That's another one I've seen. And
So connected topic to this answer would be when you invest, what are your as an investor, what are your upsides? Like, are you hoping for an upside based on the returns they promise to you, like 10%, 12%, 15%, whatever it is, right? Or
yes,
are you also looking at upside based on when the property gets sold,
yeah, well,
like equity gains?
that's why you want to look at the investment strategy that you're interested in. You want to understand when projects become offered to you, if they follow the investment strategy that's going to fit what your needs are. So if you need money now, if you want cash flow now, you need to make sure that you're getting involved in a syndication that's offering immediate cash flow. That's going to pay you money on a quarterly basis. If you can wait till the end and get higher returns at the end, and possibly either lower returns now or no returns now, then you look for something that's more growth oriented. So it depends on what you are looking for and your understanding of the deal. The deal's going to be whatever the deal is. And, people are out there looking for great deals, and they're putting them together and they're deciding what they look like, and they're offering that out to private investors. And you just need to look at the deal and say, yeah, this one works for me, or I'm not quite sure about this one. I'm gonna wait or pass.
So how do I learn more about this? I want to get my first fund together this year as a principal investor, and so what are the options and what do I need? Do I need any kind of licensing other than my real estate license?
So
You
you
said
want to
it
be
is
the investor or you want to be the syndicator?
the syndicator. I'm already
Okay.
invested in multiple properties.
Okay, well, let's go on to the next slide to answer that. So this is how we could use the syndication model on smaller deals. Basically, how you can do your own version of a syndication. Now, to go right into being the syndicator on these kinds of projects and commercial projects and stuff, yeah, you're going to have to wait until you've developed some experience and done a few smaller deals before you can even think about that. So let's talk about what you need to do to start doing those smaller deals that are syndication style. You need to really do a lot of education around a lot of things. So you can see here a bunch of them are named. Do you want when you get to the big guns, you're going to need to know all of this or have people who know all of this. But until then, you want to know at least a little something about each one so that you're not stubbing your toe and getting involved in some sort of a deal that isn't going to work out. For example, rentals laws. Let's say that you buy some kind of a multi-unit property or even a single family and you want to do Airbnb. Well, you better make sure that there's Airbnb is allowed in that area. So that's just one of the many things. And how do you get this education? Well, there's a bunch of ways out there. Podcasts, books, webinars, boot camps, meetups, networking groups, mentors. I think that the important thing is to be out there and talking to people and meeting people who are interested in the same thing. You guys as real estate agents have a great opportunity because you're showing people houses all the time. You're fielding questions about, potential purchases and sales. When you start hearing that somebody is interested from an investment perspective, that's when you want to start, asking them some nosy questions like, oh, what are your plans? What are you thinking about doing? Well, I'm considering doing a fix and flip. Oh, do you have any experience with that? Yeah, I'm in construction. Oh, good to know. It's like, start to meet these people and understand what they do and know. Or maybe they don't do construction. Maybe they are in, oh, I work for, the studios and I'm a brand consultant and I do in charge of social media. Oh, good to know. It's like all this kind of stuff, no matter what their area of expertise is, you can probably fit them into a category that will help you to, so you want to grow your arsenal with all the people that you come across and figure out what their strengths are and find out, you know, what their interest is in becoming an investor with you on a project. Yes.
I wanted to kind of in answer to Monty's question, if you're doing a bigger deal, you can actually do it with less experience, but you have to have a sponsor to give you the credibility to be able to pull that off.
That's a very good point.
Yeah, but this way, starting smaller, you could actually do it yourself with your own team, but a bigger one you could pull off
Yeah,
with a
that's true.
sponsor and a team. But
Yeah.
the sponsor is the one who you're leveraging the credibility of.
And frankly, sponsors can be bought, so to speak. So you can find somebody who is very versed at doing these kinds of deals and who can give you the guidance and say, sure, you know, for 5%, I'll be your sponsor and I'll help you to design this and understand what you need to do and mentor you along.
Right.
So essential team members that you're going to want to start gathering in your back pocket. So you might or might not be the GP. And you might be one of these other folks. You could be the deal analyst and be in charge of acquisitions. You could be the property manager. You could be the capital raiser. Or you can start looking for lenders, contractors, real estate attorneys, CPAs, appraisers, bookkeepers, investors, of course, very important, advisors, mentors, county worker, if you're doing fix and flips, and real estate agents. Now, obviously, you guys are all real estate agents, but real estate agents, if you're interested in doing some investing on your own, like you find a property that you would love to be involved in, but you don't have the cash to pull it off yourself, and or you don't have the expertise to do the remodel or, you know, whatever it is, partner up with other real estate agents, you know, this is the way that we can take advantage of the business that we're in and make ourselves personally wealthy and be much more of value to our clients and prospects because we understand this stuff. The process. So if you were to be putting together your own syndication, then you wanted to figure out and put together a sample deal package and then use this sample deal package to present it to investors. This is the way you're going to get people interested in your project. These are the kinds of projects and or get people helping you to find deals. These are the kinds of projects I'm interested in. This is how it looks like in general. I like, you know, duplexes in the general LA area, you know, that have, you know, whatever square footage or, you know, whatever the situation is. Then once you have this sample deal package, you can start talking to potential investors, get a soft commitment, find out, you know, if they're interested in buying in. And if you got enough people who are getting enough soft commitments, then you can actually go out and find the actual deal, get it started. You should get at least 25 to 50% more soft commitments than you need because people are flakes and they will bow out, even though they say they are interested. When push comes to shove, maybe they won't.
They might just chicken out and wait for your next deal.
Yeah. And then
See how you do.
once the deal is under contract, that's when the action starts. So you got to be ready to rock as soon as that happens. You want to get your attorney to prepare the offer memo. This is after you've already vetted the project out and make sure that, yeah, you know, you've done your inspections. It looks like this is a go because you don't want to be paying money to attorneys and then go in and inspect the property and find out, oh, this is a little bit more beat up than I thought. And then you want to get your investors to sign off on their subscription agreement and wire the funds to escrow. And then when all the funds are there, close the deal. Your next steps is, first of all, who are you in this picture? Do you want to be the GP? Do you want to be the deal finder, the property manager, the capital raiser, or the investor? I know what I want to be, and I think we should all in this room be interested in being the investor as well as some other piece of the puzzle. And practice with the smaller deals, build your team, develop your process, hone your skills. Once you start repeating the same process more than once, then you become good at it. And then you can really start to sharpen your tool belt at that point. Join meetups, networking groups, partner with other agents and entrepreneurs, talk to people and find out what their strengths are and how they might be able to fit into your team as a consultant, if nothing else. Potential investor would be best. And find financing. And I've got one really big clue on where to find financing. Ta-da! I put my stake in the ground at raising capital. So I am an investor and I raise capital. So if you need funding, if you need to find financing for a project, then start here. I'm putting out my message to the universe that I'm an available resource and I can connect investors with great projects.
I noticed on your deal you invested in, it looked like it was 100% cash deal.
Uh-huh.
But you could still do with financing,
Yes,
which is again where the sponsor comes in.
yes,
So you don't need to raise 100% of it.
you don't.
Yeah.
So, and that's why, I mean, obviously, it's the obvious choice for me since I'm a lender that, you know, if I can find the standard lending options that work for you. And then maybe if it's 20% down deal, for example, then you just need to find investors for the other 20%.
Usually commercial is 30%.
If you're going commercial.
Yeah.
But
well,
we're probably talking on the smaller scale.
Yeah, but anything over 5 units and up is gonna be commercial.
Yes. And who do you know that wants to be a private investor and make solid returns in real estate? Not have to find the deal or analyze the deal or take all the risks, earn passive income, diversify from the stock market, and have a trusted resource for investment opportunities. Would then look no further. Thank you. You guys have any questions? And do you feel like you are now understanding the concept of syndications and feel comfortable with why they might be a great investment and a great way to go?
You know, I need a lot of help.
The finding the sponsor, I think that seems tricky to me.
We have one in-house. We just gotta leverage him.
Who's that?
Paul Morris.
Oh, yeah.
He's big time into it.
You know, Cindy, I have to go. Thank you so much for the class. I do want to talk to you and I do want to go over some of the stuff with you that you have. I have an opportunity, but when I'm reading it, I don't know what I'm reading. Like they have that page that you showed and I'm like, okay, well, this means it's like another language to me.
Yeah,
Anyway, I have to go, but thank you so much. I'll see you guys later.
you're welcome. All right, thanks, guys.
And then I feel like finding the property, if you're using that sponsor, then are they helping you find the property?
No,
You're doing it yourself, so you really have to be able to evaluate all those
yeah, you
commercial deals, like the cap rate and
Now,
everything else.
that's typically what it's all about. Typically, these are very separate types of functions.
Mhm.
But that doesn't mean that there are, you know, especially in the beginning, there aren't crossovers.
Mhm.
So, yeah, I mean, you should generally expect that the GP is going to be your mentor, your guide, your person who's going to help you with financing, the person who knows the ropes.
They're not gonna go to work
Point you
for
in the
you, but they'll
direction.
point you in the right track and say, you're on the right track. And then when you think, you say, I think I got a good one, you send it to them, they'll like, say, yeah, that's good.
Now, if that person is also a deal finder, you know, then maybe, you know, once they've had that conversation with you, and know exactly what you want to spearhead, they can find it.
They may take more of a cut depending on how much work they go.
Exactly. I mean, everything's negotiable in this world.
Cool.
Cindy, question for you. How much does the GP bring in? Like what percentage and what percentage you as a person putting the deal together has to bring in?
What does the GP,
I mean, like, let's say you have to bring in 30% equity and the rest is financing, right? So out of 30% equity, what is the expectation for the GP to bring in? Like, are they bringing in like 10% or something, or are they just bringing in knowledge here in this case?
so that falls into that category of everything is negotiable. So I say that it depends on the situation. If this is a project that the GP wants in on, then they might very well want to and put money in the deal and become, you know, a major owner. Because if you, let's just say they put in 10% in the deal, 10% on a commercial property of ownership is pretty significant. So they may want to do that, they may not. So they don't have to, there's no rule, you know, and there's no, you know, I mean, I guess if you say what's common, maybe something like a 5% ownership, but that doesn't necessarily mean that they're putting in 5%. It might mean that they're getting 5% for their expertise and their ability to get the bank to put in money.
Oh, so that's what we're offering them for their expertise to put everything together. Potentially. I mean, it could be like they bring in 2% and we give them 3% more for running everything, something like that.
Could be. I think,
Oops.
you're saying it could be that they take 2 or 3%, Monty?
Yeah, my question is, and again, I can't see who's in the class because the video is small here. But my question is that, well, in this case, I'm kind of new to this, but I've done a lot of M&A deals. So a lot of terms that Cindy mentioned seem very familiar from the M&A side. But let's assume that in this case, as Cindy mentioned, there's a GP who's actually the person responsible, right? In terms of making sure everything gets paid, he gets paid last, he takes more of the risk. But my question is, does he also bring in some equity, or are we just paying him for taking this, running in his name and so on? And usually is it some kind of a mixture where maybe he brings in 2% and we offer people with no equity or so on to run everything, right?
Yeah, there's no rule, because you saw in the deck that I showed you of the deal that I'm involved in, the GP put in 10% of their own funds.
Okay.
That doesn't necessarily have to be that way. They could put in 0, they could put in more.
Okay, got it. Okay, this is very exciting. I didn't even know about this class actually. I'm right now calling you from India, New Delhi actually right now. And I just happened to chance to join the meeting right at the time when you talked about this class. And so I'm so happy I joined here and really learned quite a bit. Thank you.
Okay.
Enjoy
thank
India.
you.
Good to see
I'm
you,
in New
Monty.
Delhi. Yes, New Delhi, India right now.
All
Thank
right,
you.
have a good
It's
one. Later, bye.
it's very early in the morning here, 12:43.